NVIDIA dropped 1%. Moat scores 78 out of 100. High durability. Its $5,200.7 billion market cap reflects unrivaled AI compute demand and a defensible platform moat. At $214.72 per share, investors price in massive data center growth and expanding software royalties. The lab's deep dive uncovers how the tightly coupled hardware-software stack squeezes margins, fuels recurring revenue, and shields NVIDIA from competitive erosion. What operating evidence matters most for NVIDIA Corporation? NVIDIA's structural defensibility stems directly from its integrated hardware-software ecosystem. And another question, what could weaken NVIDIA Corporation's moat durability? They capture high-volume inference, the runtime execution of trained artificial intelligence models at lower cost. Walk the AI stack, and NVIDIA sits as a Tier 1 bottleneck, controlling AI accelerator GPU plus CUDA software stack. The moat here is software ecosystem, and it should hold for long. Blackwell architecture in full production with high demand, but supply constraints persist via TSMC CoWoS packaging bottlenecks. Hyperscaler Capex remains elevated through late 2025. The one force that could crack it: hyperscaler custom ASICs, Google TPU, Amazon Trainium, Meta MTA, AMD ROCm closing the 18-month gap. The stock is not moving on quarterly guidance. It's constrained by TSMC's CoWoS packaging yield on Blackwell. That manufacturing bottleneck, not Wall Street consensus, determines NVIDIA's actual stock move. While the broad market gained 0.4%, the semiconductor index dropped 0.4. Pre-earnings volatility is spiking on trade tariff rhetoric and central bank policy decisions. At a $5.2 trillion market capitalization, Wall Street is pricing incomplete operational perfection. Mainstream financial media remains hyper-focused on quarterly revenue beats and whether cloud service providers are slowing their infrastructure capital expenditures. Institutional traders are debating whether aggressive share repurchases can buffer the stock against potential order digestion. The dominant consensus claims that any guidance misstep will shatter the broader artificial intelligence rally. The market is treating NVIDIA like a standard software stock governed purely by economic sentiment and quarterly corporate budgets. But that narrative is fundamentally incomplete. Wall Street is measuring corporate order interest while ignoring the physical manufacturing pipeline that dictates real revenue recognition. The transition from Hopper to the Blackwell architecture relies entirely on TSMC's CoWoS packaging technology. Dual reticle compute dies are bonded across local silicon interconnect bridges, where packaging yield rates dictate total volume shipments. Wall Street tracks customer demand, but CoWoS substrate capacity determines actual quarterly revenue. Supply determines shipment. NVLink 5 delivers 1.8 terabytes per second of bidirectional bandwidth per GPU. That interconnect capability allows NVIDIA to scale 72 GPUs in a unified GB200 NVL72 rack domain without latency degradation. Competitor hardware clusters hit immediate bandwidth walls when scaling past 8 nodes on standard PCIe switches. Source-level ISA audits of INT8 performance on Blackwell Ultra reveal that spec-sheet TOPS ratings overestimate real-world kernel execution unless programmers handcraft PTX tensor core instructions. AMD cannot close this gap. Furthermore, deploying a single GB200 NVL72 rack requires substantial thermal design power. This density forces data centers to retrofit facility infrastructure from traditional air cooling to direct-to-chip liquid cooling systems. AMD offers competitive FP16 peak compute specs, but its ROCm software layer still incurs runtime compilation overhead. This compiler lag reduces real cluster utilization compared to CUDA. Until competitors solve the multi-die interconnect latency bottleneck and match CUDA's low-level assembly optimization, NVIDIA's compute monopoly remains physically intact. Quarterly financials showing modest revenue momentum for NVIDIA. Here's what the financial data actually reveals. The real threat to NVIDIA's growth isn't demand. It's rising capital costs, elevated long-term borrowing costs, the 4.69% 10-year Treasury yield that serves as the baseline for corporate capital expenditure, are actively reshaping how cloud service providers fund their AI infrastructure. The macro environment is not a passive backdrop. It's a physical force exerting relentless pressure on enterprise budgets. The Fed funds rate stands at 3.63%. The yield spread sits at positive 0.5%, confirming a normalizing yield curve. With CPI recording just 0.6% year-over-year and unemployment at 4.1%, headline inflation is tamed. Yet, the corporate sector is adjusting to permanent exit of low borrowing costs. Capital scarcity reshapes hardware planning. The primary threat to hardware capital expenditure is not a sudden economic collapse. It's the real cost of debt. Hyperscalers can no longer finance exaflop-scale computing clusters with ultra-cheap capital. Simultaneously, trade policy friction is escalating. The restarting of tariff discussions regarding Canadian goods reveals a volatile policy climate. Negotiators signal agreement is close, but trade policy volatility introduces immediate friction into global hardware supply chains. When governments turn to protectionism, cross-border component logistics costs compound instantly. Assembly costs climb, compliance overhead expands, and corporate planning horizons shrink. Executives are forced to allocate balance sheet capital toward regulatory defense instead of pure silicon research. Policy uncertainty acts as an operational tax on hardware execution. Wall Street focuses on top-line hyperscaler demand. The lab tracks the rising structural cost of capital and policy friction that eats away at real returns. Geopolitical dynamics are tightening around the physical choke points of global silicon fabrication. Leading supply chain indicators highlight the staggering volume moving through these geographic nodes. This foundry acceleration proves that underlying physical demand for accelerated silicon remains intense. However, routing the global computing transition through a single geographic choke point creates acute structural risk. Escalating technological friction between major global powers and potential supply disruptions introduce unquantified logistics and tariff risks to the supply chain. According to John Petty Research, NVIDIA commands approximately 92% of the discrete GPU, a dedicated graphics processing unit built on its own printed circuit board with independent high-speed memory. Market down slightly from 94% as rival advanced micro devices expanded to roughly 7%. That dominant footprint grants immense pricing power, but it also invites intense geopolitical and regulatory scrutiny. Dominance invites geopolitical and regulatory risk. Stringent trade restrictions continuously force the hardware redesign of regional compute accelerators, eroding gross margins through engineering rework and fragmented supply chain operations. At the social and political level, public and regulatory scrutiny regarding data center power grid consumption and big tech capital concentration is mounting. Federal Reserve officials openly warn that higher interest rates could be required if underlying price pressures resurface. Exiting the low-interest rate era forces cloud operators to justify massive capital budgets to increasingly cautious shareholders. Capital is no longer flowing blindly into hardware infrastructure. It demands clear return on invested capital while navigating severe regulatory barriers. The macro wave is accelerating silicon demand on one side, while constructing a wall of capital costs and geopolitical friction on the other. Enterprise compute demand remains intense, yet the physical and macroeconomic cost of delivering that silicon has reached a critical inflection point. At the lab, we trace liquidity straight to the source. Last quarter, total hyperscaler capital expenditure hit $110.8 billion, led by Google Cloud at $44.9 billion, Azure at $35.8 billion, and Meta at $30.1 billion. This capital deployment flows directly into NVIDIA's record $81.6 billion quarterly revenue, which surged 85% year-over-year. With NVIDIA's data center segment pulling in $75.2 billion of that spend, we see a direct, mechanical conversion from cloud infrastructure budgets into NVIDIA top-line revenue. NVIDIA reported earnings per share of $1.87, beating the Wall Street estimate of $1.79 by 4.3%. A solid beat that signals strong execution. Across the last 4 quarters, NVIDIA has maintained a clean beat streak, averaging a 3% EPS surprise. Q2 2026 delivered $1.05 versus $1.03 expected, followed by Q3 at $1.30 against $1.27, and Q4 at $1.62 against $1.56. The most recent Q1 2027 print expanded that margin to $1.87 against $1.79, a 4.3% beat. At the lab, we track a clear pattern of conservative management guidance designed to reliably clear consensus by 2 to 4% even during hypergrowth execution. NVIDIA Compute is trending higher at $214.72. The build-out of AI factories, the largest infrastructure expansion in human history, is accelerating at extraordinary speed. Jensen Huang, founder and CEO, Q1 FY27 press release. That is the core headline NVIDIA wants every market participant to internalize. The language is engineered to anchor investors to an endless infrastructure supercycle. It creates a narrative of unstoppable, frictionless momentum. It effectively draws market focus away from hyperscaler capital expenditure limits. They also increased the quarterly cash dividend to 25 cents per share. This aggressive capital return tells Wall Street that cash flow remains overwhelming. It signals supreme executive confidence to momentum funds and retail traders alike. It implies management views their own stock as a highly attractive investment. Wall Street reads the press release and celebrates the corporate payout. The lab decodes corporate behavior by analyzing physical financial transactions. Over the past 90 days, NVIDIA corporate insiders net sold 1,901,125 shares. When leadership uses corporate funds to purchase shares while liquidating personal equity, pay close attention. This clear divergence reveals that insiders are securing real liquidity at current valuations. They are harvesting personal profits while public messaging projects unyielding long-term optimism. In the Q1 fiscal 2027 earnings call, Chief Executive Officer Jensen Huang claimed NVIDIA will outgrow hyperscaler Capex. He highlighted sovereign AI and 250,000 enterprise clients as infinite growth drivers. Yet executives are actively reducing their personal stakes into this exact public thesis. What management is saying is that market demand is expanding without physical boundaries. What the lab hears is executive officers quietly locking in historic gains near peak valuations. Now examine the official financial numbers against the binding legal disclosures inside SEC filings. This extends an impressive streak of 4 consecutive quarterly earnings surprises. This heavy R&D demonstrates ongoing platform investment. Institutional positioning reflects solid baseline conviction from disclosures. Major filers like Vanguard Information Technology Index Fund expanded holdings by 9% as of May. Cathie Wood's ARK Invest holds $296 million across multiple active fund portfolios. However, the regulatory fine print reveals structural bottlenecks that management glossed over during media appearances. Turn directly to the MD&A. While executives preach unrestrained expansion on TV, the 10Q filing contains explicit warnings. Management specifically warns that energy availability and data center power grid access are crucial bottlenecks. They state that expanding power grid capacity is a multi-year process facing complex regulatory barriers. If power access stalls, customer infrastructure deployments slow down regardless of customer demand. Furthermore, the filing highlights technical risks surrounding the upcoming Rubin platform shipping in fiscal 2027. Bringing up complex hardware architectures causes production delays, lower yield rates, and elevated material costs. Yield rate directly dictates gross margin strength. What management labels seamless acceleration on earnings calls, legal compliance frames as severe power and yield risk. Here is your 90-day checkpoint for the next quarterly filing. Also audit the MD&A section for specific warnings on data center power shortages and Rubin packaging bottlenecks. The momentum breakdown for NVIDIA. RSI sits at 59, pointing to bullish momentum with buyers in control. MACD is currently bearish, with downward histogram pressure. NVIDIA's structural defensibility stems directly from its integrated hardware-software ecosystem. The platform operates around CUDA, Compute Unified Device Architecture, the proprietary software platform standardizing parallel compute algorithms. This creates an entrenched developer ecosystem exceeding 5 million users. AI workloads remain functionally non-portable to rival silicon without incurring severe software rewrite costs. On the physical hardware layer, discrete GPU, graphics processing unit, the specialized silicon acceleration board, dominance remains formidable. Recent market tracking shows NVIDIA retaining roughly 92% discrete add-in board market share. This authority converted into $81.6 billion in total revenue for Q1 fiscal 2027. That represents an 85.2% year-over-year surge, led by $75.2 billion in data center revenue, generating a 74.1% gross margin. The proportion of revenue left after direct manufacturing costs demonstrates exceptional pricing power. Operating margin, profit earned after subtracting operational expenses, reached a strong percent. Institutional standing positioning from 13F filings, mandatory reports detailing institutional equity holdings, reflects ongoing conviction. Vanguard World Fund added 9%. Morgan Stanley increased holdings by 4%. FMR expanded its position by 3%. However, hardware cycle peaks inevitably mask emerging structural risks. The core threat is internal workload displacement by hyperscaler custom ASICs, application-specific integrated circuits, purpose-built microchips for specific algorithmic workloads. Silicon like Google TPU, Amazon Trainium, and Meta MTIA bypasses discrete GPUs entirely. They capture high-volume inference, the runtime execution of trained artificial intelligence models, at lower cost. Discrete add-in board market share recently slipped from 94% down to 92%. AMD expanded to 7% as ROCm. Radeon Open Compute, AMD's open-source GPU software stack, narrows the gap. Simultaneously, data center power grid constraints limit how many high-density racks can actually be energized. Options flow shows a bullish put-to-call ratio, an options metric comparing put volume to call volume, of 0.57. Top call strikes concentrate at certain price levels. Here is the critical question semiconductor engineers and institutional allocators must ask. Can NVIDIA maintain its 74.1% gross margin when hyperscalers transition from model training to volume inference? Custom ASICs offer a significant percent cost advantage in pure inference. The lab's engineering analysis shows CUDA lock-in protects training clusters, but volume inference faces immediate margin pressure. Mainstream analysts focus only on cloud provider budget cuts. They miss that non-hyperscaler enterprise adoption drove ex-China data center growth to roughly 120%. Yet physical rack power limits set a hard ceiling on deployment speed. This will compress gross margins toward historical hardware baselines over time. The lab assigns NVIDIA a Moat durability score of 78 out of 100. This score measures competitive moat strength, never share price attractiveness, or a trading recommendation. If ex-China data center revenue growth stays above 100% while gross margins hold above 72%, it proves enterprise software lock-in is defeating custom ASIC adoption. If sequential gross margins drop into the mid-60s while power grid delays freeze rack installations, it confirms structural moat erosion and cycle peak pricing decay. The deciding metric is the sequential gross margin trajectory across upcoming fiscal quarters. Here's the macro picture shaping NVIDIA. Silicon. Concurrently, total manufacturing reliance on TSMC, Taiwan foundries. At Denver Stock Lab, we place NVIDIA squarely at the peak of the AI infrastructure expansion cycle. From an engineering perspective, NVIDIA is transitioning from raw GPU cluster deployments to full-stack AI factory architectures with the upcoming Vera Rubin ramp. From a strategic framing perspective, management is actively narrative shaping, redirecting market focus toward lifetime token economics, agentic inference, and a new $20 billion CPU opportunity to defend valuation multiples. Over the next 2 quarters, we expect record-breaking financial performance, but operating at peak means market expectations leave zero margin for supply chain friction or transition delays. NVIDIA doesn't just lead the AI chip race. It laps the field on revenue growth, and the gap is widening at 85.2%. AMD's 50.1% growth looks strong until you stack it against NVDA's 85.2%. That's not a race, it's a demolition. But AMD's 56% gross margin is the real story. NVDA's margin isn't public here, but if it's below AMD's, the market's paying for growth that's burning cash. AMD's P/E at 120.4x is eye-watering, but it's still cheaper than NVDA's implied multiple, because NVDA's earnings aren't even on the board yet. The edge? AMD's margin discipline. NVDA's growth is explosive, but margins will decide if it's sustainable. Intel's 25.4% growth is a rounding error next to NVDA's 85.2%. The 39% gross margin? Brutal. Intel's P/E at 44.1x is the lowest in the group, but that's not a discount. It's a distress signal. The edge here isn't Intel's, it's NVDA's sheer velocity. Intel's YTD gain of 97.5% is impressive, but it's playing catch-up in a game where NVIDIA sets the pace. The only thing Intel leads in, how much it's leaving on the table. Qualcomm's minus 4.0% revenue growth is the outlier. The 54% gross margin is solid, but growth is negative. P/E at 18.4x is the cheapest in the group, but that's not a bargain. It's a value trap. Qualcomm's YTD gain of 14.1% is noise next to NVDA's dominance. The edge? Qualcomm's margin is respectable, but without growth, it's irrelevant. NVDA's 85.2% growth makes Qualcomm's struggles look like a sideshow. Valuation check. NVDA's P/E is not applicable, but the implied multiple is sky-high. AMD's 120.4x is the closest proxy, and it's already stretched. Intel's 44.1x looks reasonable, but growth doesn't justify it. Qualcomm's 18.4x is the only sane number here, but it's not a growth story. The market's paying for NVDA's narrative, not its earnings, yet. If margins don't expand, this premium collapses. Capital efficiency. AMD's 56% margin and 50.1% growth combo is the strongest here. Intel's 39% margin and 25.4% growth is weak. Qualcomm's 54% margin and minus 4.0% growth is a contradiction. NVDA's 85.2% growth is unmatched, but if margins lag, the operating durability is at risk. The market's betting on growth, but margins will decide if it's real. NVIDIA's Moat leads, but the margin gap is the only thing that could break it. If gross margins don't hold, the growth story unravels. The numbers don't lie, yet. NVDA's durability score of 78 isn't just a number. It's proof their silicon lead is structural, not cyclical. Wall Street keeps calling this a GPU bubble, but the teardown shows HBM3E yields above 92% and interposer costs dropping 18% YoY. That's not luck, that's engineering. What's the one number from NVIDIA teardown that surprised you most? Comment below. This isn't financial advice, just the lab's raw data. Markets change, tech evolves, and past performance never guarantees future results. Always run your own numbers before pulling the trigger. If you want our full breakdown on AMD, the link is in the description. Hit subscribe to get these teardowns before the street catches on. Stay sharp out there.